Hi class. In this video we're going to look at a problem that's very similar to P9-17 in your homework. So this chapter we're going to look at budgeting. So there'll probably be a little bit of scrolling, and I apologize for that, but let's see what we've got here. Minden Company is a wholesale distributor of premium European chocolates. The company's balance sheet as of April 30th is given below. So we've got a balance sheet, and then it says the company's in process of preparing a budget for May and has assembled some data. We have items A through G that we're going to need to finish this problem. So there's several things we have to do in this problem. And it says requirement 1A is to prepare a schedule of expected cash collections from sales and a schedule of expected cash disbursements for merchandise or for merchandise purchases. All right, so I've got templates down here which should help. So our schedule of expected cash collections, so we're looking at what are we collecting cash for as part of our business. Well, we would be collecting cash on sales. Of course, this is a balance sheet, so it's not going to tell us about income directly, but let's look at and see what we have down here in these items that are relevant to the collection of cash on sales. So we've got sales are budgeted at $257,000 for May. Of these sales, $77,100 would be for cash. So that sounds important to me. And then it says the remainder will be on credit. And then it says one half of a month's credit sales are collected in the month the sales are made, and the remainder are collected in the following month. All of the April 30th accounts receivable will be collected in May. So that sounds important too. It's like item B is about purchases, so that shouldn't be about cash received. We've got an inventory balance, which doesn't sound relevant. Selling and administrative expenses and depreciation, all of those would be cash going out. So again, we're not talking about cash collections. Note payable and equipment purchase, and we've got a borrowing here, so that does have to do with cash coming in, but not from cash collections for sales. So looks like we only have item A that's relevant at this point. So it says of these sales, $77,100 would be for cash, and that's for May. So we can scroll down, and we've got cash sales for May are $77,100. So that just comes directly from the instructions. Then we have to figure out collections on accounts receivable for May and for April. So there were some credit sales that we need to figure out. So this says all of April 30th accounts receivable will be collected in May. So accounts receivable is a asset account, so that should be on our balance sheet. So this is our balance sheet as of April 30th, so that gives us our accounts receivable balance for April 30th. And it says we're going to collect all of that. So we're just going to take that $54,750 and put it down here, because we're collecting all of that in May. Let's see. And then we are collecting some of the May credit sales in April, but not all. So we've got $257,000 in sales for May, but of those, $77,100 would be for cash. So let's see what our credit sales are. So if we take $257,000 and subtract out $77,100, gives us, nope, mashing the wrong button here. Let's see, 257 $257,000 minus $77,100 is $179,900. So that's the amount of credit sales that we're working with. And then it says one half of each month's credit sales are collected in the month the sales are made. So one half of the $179,900 will be collected in May, and then the rest will be collected later on. So down here, let me write this out so you can see what I'm doing. So I took the, let's see, the total sales of $257,000. Subtracted out the cash sales of $77,100, I think, yes. And that gave me $179,900. And then, let's do it this way. 50% of that was collected. So if I take 179,900 times 50%, it's like 89,950. So this is just the formula that I use to calculate the collections of cash for May sales. So then our total cash receipts are just the total of all those. Our cash sales in May, our April 30th sales, or April collections on sales, and then our May collections on credit sales. So the answer to that one is $221,800. So we're going to kind of go through the same process with, whoops, I didn't finish my title. Well, I did, it just didn't show up. There. With our schedule of expected cash disbursements. All right, so we've got an April accounts payable balance, a May purchases that we're going to make, and then that'll give us the total cash payments. So our April accounts payable balance is going to be in the balance sheet. And that's right here, $70,500. So we're going to scroll down and put that here. And then our May purchases. See what it talks about here. Item B talks about purchases of inventory, and that's what we're looking for. So it says we are purchasing $121,000 of inventory during May. And those purchases are on account, but 40% of all those purchases are paid for in the month of purchase. And then here's all of the April accounts payable paid during May, so we already got that part. So 40% of $121,000. So let's go down here. This is $121,000 times 40%. Oops. Try that again. There we go. So $121,000 times 40% is $48,400. So here's our schedule of expected cash disbursements, and these are cash disbursements for our inventory. So our total cash payments would just be the cash we paid out for our accounts payable that carried over from April, plus the 40% of the the purchases on account we made during May. So we're going to total those. And that gives us $118,900. All right, so 1B says prepare a cash budget for May. So again, I've kind of got a template here. And it looks like we might have to add some lines to it. Looks like I forgot a few, but we're going to start with our beginning cash balances, add our cash collections, and then subtract our cash disbursements. And then we're going to look at our financing and see how that plays into that. So our beginning cash balance, cash is an asset, assets on a balance sheet, and we have a balance sheet. So our beginning cash balance was $9,600. And then we're going to add our collections from customers. And that comes from up here. So we calculated schedule of expected cash collections. So this $221,800 comes down here. And then we have total cash available, and that's where I forgot my line, so let me put that in there. So our total cash available would be the cash we started with plus the cash we collected. So that's just the total of those two. It says $231,400. Now we're going to take out our disbursements. So the first thing I have listed is our purchase of inventory. And again, up here is our schedule of expected cash disbursements, and that was for the purchase of inventory. So that $118,900 goes down here. Oh, let's see, selling and administrative expenses. Let's go back up to our instructions. So we already took care of A. We already took care of B. Oh, here's our selling and administrative expenses. So selling and administrative expenses for May are budgeted at $83,700, exclusive of depreciation. So these expenses will be paid in cash. Depreciation is budgeted at $2,800 for the month. But remember, depreciation is a non-cash flow. However, it does make a difference in our income statement, but not in our cash budget. So when we're doing our cash budget, let me get down here to it. When we're doing our cash budget, our selling and administrative expenses for cash purposes are the $83,700. And then we had a purchase of equipment. So let's go back up here. I believe it's that. The new refrigerating equipment costing $13,100 will be purchased for cash during May. So that entire amount, $13,100, goes down here. So let me put my line in. Total cash disbursements is just the total of those three items. There was nothing else that we paid cash for. And then we have an excess or a deficiency of cash available over cash disbursements. So I'm going to take our cash available, and less our cash disbursements, gives us an excess of $15,700 in cash that we have in available over disbursements. So now we're going to look at our financing. So down here I've kind of still continue my template. Looks like we've got some borrowing and some repayments and some interest. So let's go back up here. All right, so it looks like item E and item G both have to do with a note. Item E, it has to do with a note being paid, and G looks like it is a note that's borrowed on. So let's do G first. It says during May, the company will borrow $22,000 from its bank by giving a new note payable to the bank for that amount. So they're getting $22,000, so that's a cash inflow. So that is a borrowing coming in. And our repayments was the other one that we looked at, so that's E. So we've got a note payable with $340 interest. So the $340 interest is a cash outflow. And the note, it doesn't tell us how much it is here, but we should be able to find that on our balance sheet. So there's our note payable of $18,100. So that's a repayment, so I'm going to put that in parentheses. And the interest was $340. So our total financing is the net of those three, the one cash inflow and the two cash outflows. So our total financing was an actual inflow of $3,560. So our ending cash balance, because we started with beginning cash, added our collections, took out our disbursements, and then we have some financing that netted out to a positive, so we're going to add that in. So we're going to, in this one, we're going to take our excess cash, which was the last subtotal that we did, and we're going to add to that the financing that we added to our cash. So our ending cash balance for May is $19,260. So the next thing we're going to do is do a budgeted income statement. So again, I've got a template we're going to start with. So we're going to start out with sales. And I think they told us that amount. Yes, sales are budgeted at $257,000. So let me see if I can hide some of this for now. Might make it a little easier than the constant scrolling. All right, it's a little closer. So our sales were $257,000, and that was given. And then we're going to calculate our cost of goods sold. So we've got a beginning inventory, purchases, which will give us the goods available for sale, and then we're going to subtract out our ending inventory. So let's see what we got about inventory. So our beginning inventory should be on our balance sheet from April, because whatever was the ending in April should be the beginning in May. So there's $53,750 in beginning inventory. We're going to add our purchases, which were $121,000, and that's listed in item B. And it doesn't matter whether we paid cash or credit. Those were still purchases regardless of how we paid for them. And we're doing an income statement, so we're going to consider all purchases. So we're going to add those two together to give us our goods available for sale. We're going to subtract out our ending inventory. And I think that was somewhere down here. Gotta look for it. Oh, the May 31st inventory balance is budgeted at $31,000. So that's item C. So here's our ending inventory of $31,000. So our cost of goods sold is our goods available for sale, less our ending inventory because we didn't sell those yet. So that's $143,750. So our gross margin would be our sales, less our cost of goods sold. This is $113,250. Our selling and administrative expenses, I believe those were given up here. We just looked at those a minute ago. So item D. And this one we're going to actually use the cash expenses of $83,700 plus the depreciation of $2,800. And that's because we're working with an income statement. An income statement includes depreciation. It doesn't care whether it's a cash expense or not. It's still an expense. So we're going to add those two together. It should be $89,950. Let me just write this out here so we can have that to refer back to. So that was the $83,700 plus the $2,800. I think, yes. So that's just where that came from. So our net operating income would be our gross margin less our selling and administrative expenses gives us 20, let's see. I've got something wrong. Let's see. That should be 86,500. I can't do math today. 86,500. So our net operating income should be $26,750. And then our interest expense, that interest expense, of course you'd have to find it in a set of instructions, but I remember what it was. It was for that note. So that's that $340 in interest we paid on the note payable, so it goes down at the bottom. And then of course we're going to subtract that out of our net operating income to get our net income. And net income is $26,410. All right, so then requirement 3, which is the last part, is to prepare a budgeted balance sheet. So again, I have a template here. And we've got the first thing we started with was cash. So to know what our cash balance is, we're going to go back up to our cash budget, because oh, I hid it. Hid it from myself. Let me unhide this stuff. So here's our cash budget. So the cash budget tells us what we believe our ending cash balance is going to be for the month. So this number here, the $19,260 from our cash budget, is going to carry down to our balance sheet. Our accounts receivable, we have to go back to our instructions. We sold $257,000 of sales, $77,100 of that was for cash, so the difference will be our credit sales, and 1/2 of those months' credit sales are collected in the month of May, which mean, and we also know that we collected all of April, so we're only dealing with, we only have what's not collected for May, which is 1/2 of the credit sales. So that should ring a bell, because that's what we actually calculated here under the schedule of cash collections. So just saving myself some work, this was the formula that we used. So there's our total sales less our cash collections equals our credit sales, and we collected 50% of that, which was $89,950. So come down to my balance sheet. I'm going to put our formula down here just so we have it for reference. So that is the $89,950. Our inventory, I believe that was given to us in the instructions. Yes, item C, May 31st inventory is balanced at $31,000. And I remember that because, where is it? Oh, because we used it on our income statement. So if that rings a bell, that's why. So $31,000 goes here. Buildings and equipment, net of depreciation. So some of this, and this one's we have to be a little careful on. So normally we would have, we would just get that off of the balance sheet. So buildings and equipment net of depreciation, there's $214,000. But I remember we bought a refrigerator, I think, yes. Item F, new refrigerating equipment costing $13,100 will be purchased for cash. So that's going to add to our equipment balance. So we're going to take the previous equipment balance and add that $13,100. And I also remember that we took some depreciation. So there's an additional $2,800 in depreciation that we took. So we're going to subtract that out. So I'll write all this down here so you'll have it to look at. So our depreciation was the $214,000 from the April balance sheet, plus the $13,100 in the refrigeration stuff that we bought in May, and that was given in the instructions. And then we're going to subtract out the $2,800 in depreciation for May that was given in the instructions. So if we add these two and subtract that one, it should give us $224,300, giving us total assets $364,510. Now to liabilities and stockholders' equity. We've got accounts payable. Let's see. It says purchases of inventory are $121,000 in May. Those purchases are all on account. 40% of all purchases are paid for in the month of purchases. A purchase and the remainder are paid for in the following month. So that means all of April accounts payable would be paid in May. So we normally would look up here and find our accounts payable balance and include that in our calculations. But since we know we paid all of that off, we can disregard that. So all we have to work with is the $121,000, and 60% of that would be still outstanding because we paid 40% of it off. So let's scroll down here again. And this one is 121,000 times the 60% that's left, still is outstanding, which would be $72,600. And let's see, then we had a note payable and that was given in the instructions. We actually had two. We had one on our balance sheet, but we paid that one off. But then we received another note payable of $22,000, so that's the only one that's outstanding at this point. So we're going to put that down here. Our common stock, I don't think there was anything that said we did anything with common stock. We had $180,000 here on our balance sheet, and just kind of scanning over through these, nothing has anything to do with common stock, so that's just going to come straight down, straight way down here. And then our retained earnings. So we have to do actually a calculation for this. So retained earnings is normally on the balance sheet. So here we have $63,500 in retained earnings, and that was the retained earnings at the end of April. However, we've been doing business all of May, and so normally retained earnings would increase with net income or decrease with a net loss. Of course, we're kind of projecting out into the future, so our budgets are estimates, but we're still going to include that estimate in our updated retained earnings. So we need the $63,500 that we started with, and we need to know what our net income or net loss is, and I remember doing an income statement. So that amount right there is our net income. So we're going to take the $63,500 and add our net income of $26,410. So let me type this out here so you can see it. That's the calculation for that, and that would give us $89,910. And then we're going to sum or total that side up. Should be equal to our assets, and it is, so we are in good shape. And that is the end of 9-17. So other than the scrolling up and down, it's kind of like a scavenger hunt too, of trying to figure out where to look, whether you find stuff in the balance sheet or in the instructions. So just be careful. Your numbers, of course, are going to be different than mine, but the process will be the same. The only difference would be is if you, for example, you ended up with a net loss, and of course you would subtract that out where I just added it to the retained earnings. Other than that, can't really think of anything that would be different. So hopefully this is helpful to you. If you have any questions or you get stumped on anything, feel free to send me an email, and I'm happy to look at what you've done so far or answer any questions you have.